the last few years, we worked with a host of fintechs, largely in the deal space, also operations, etc. But Karan, I'll have to say one of the most established fintechs that we've seen in the lending space. Also, most importantly, very cautious about lending, collections. I think the brand name that you've carried, the niche that you've created, is something that we've all look up to in the fintech space. So very excited to have you here. Over to you for a quick introduction.
Great. Thanks a lot, Geetika. I think it's very, very kind words from you. Everyone, I'm Karan Mehta. I'm the founder and CTO for Kissht. We have very recently rebranded ourselves to Ring. So when I use the two words interchangeably, please don't get confused. They're essentially the same entity. We are roughly a 7-year-old tech startup based out of Bombay itself. We've been largely in the consumer lending space.
To start with, innovation being the first theme, we'll move on to regulations and how that's panning out, then move to competition, and then we'll conclude, right? So on the innovation side, Karan, how important do you think it is for a fintech startup to identify the right customer segments, create a niche for yourself, right? Or is everything literally, everyone morphing into every space? Is that what you see happening?
No, it is. Let me at least take that question and kind of, blend it with our history as an answer. When we started, like I said, there were the banks that were lending. And let me specifically talk about personal loans. There's, of course, home loans and car loans. They follow some different trajectories. But when you look at personal loans, there were banks that were very happy to give you out a loan of 5 lakhs, 6 lakhs, 7 lakhs if you were above a certain CIBIL score, if you had a certain income, but a very standard vanilla process for them. You had these other larger NBFCs who would also cater to a slightly more riskier set of customers, but again, within the bounds of credit, comfort. When we started, we said that there is a very, very, very big white space that we want to address. That there is a good 94% of India's population that's not being served by anyone. Let's start by serving to those customers. For a good 3 years of our journey, that's what we did. But if I look at our journey over the last 4 years, I realized that a lot of the lines have been blurred. Back in 2015, when we started, we were the very first wave of digital lending platforms. There was us. There was Early Salary, there was Zest, there was CreditBee, there were some 6-7 companies who all started at roughly the same time because a lot of factors in the ecosystem allowed digital lending to start. And I realized at that time when we were doing competitor mapping, we realized everyone is operating in their own space. We have almost zero overlap. Early Salary was going for the salaried people. Zest was going for the younger crowd. We were going for the unemployed and the self-employed in the NTC base. When I now look at customers that we are serving and they are serving, they're all blurred. We are serving customers. We have a good 10% of our customer base, active customer base, who are CIBIL 800 plus and who have multiple credit cards. And we sometimes question that why would this customer come and take a loan from us at an interest rate which is significantly higher than what he's getting from other places. We get customers who are affluent in metros, and we get customers who are from absolutely rural areas as well. What has now become the case with lending is, of course, you try to cater to your niche, but there is always a steady pool of customers that are coming from a lot of different segments automatically. And that's become the reality of lending. While you try to cater to a segment, your product is generally flexible enough to accommodate a lot of different segments of customers. So while you try to attract a certain set of customers, you end up serving a lot of customers of different segments. And when we are building a product now, we are kind of, not making those assumptions of segments anymore. When we are building products, we are assuming that we are serving a whole large swath of the Indian population. And that's where the difference is lying. Just to give you some numbers, right? We have close to about 24 million people who signed up. A good 7 million of those customers are people who we've given active loans to. Now, this 7 million is a mix of pretty much every use case, and it's a very, very interesting demographic to be serving.
And Karan, are you tracking your CAC very closely? Is that something that that makes a big difference in the lending space?
Oh, it makes. For example, we at our peak over the last 1 year, we were acquiring close to about 35,000 bottom of the funnel customers, which meant 1 lakh top of the funnel customers. At that run rate, having a CAC that is not in control will very, very quickly, kill you as a company. One of the biggest reasons we actually migrated from this brand called Kissht to a brand called Ring was guided by this philosophy. We wanted to be able to acquire customers at a much lower CAC. And just to give you reference numbers, our CAC in the Kissht era was roughly around 400 per user, per active user, per loan taking user. With Ring, and I will come to what are the changes we made, but our CAC has come down to as little as 80 or 90 rupees. And that actually allowed us to open up our funnel in a very, very big way. With Kissht, our CAC was largely attributed to digital marketing, Facebook, Google ads. With Ring, we have taken a model where we are onboarding merchants, and these merchants onboard customers for us. And that physical model, although it has a higher rate of attrition, the customers are tried from the first to the second cycle very, very quickly. The overall CAC is much lower.
I think good learning there in terms of tracking the CAC and finding strategies to essentially reduce that over time, right? Now coming to the product itself, right? How important is innovation now? Is it becoming commoditized, digital lending?
Yes. Now, if you look at the journeys across a lot of the different apps, you'll realize that exact same screens. Enter your PAN number, enter all the information that CKYC requires, give your DigiLocker consent. At some level, yes, absolutely. The digital lending has, and us at the early cohorts of lenders will take a lot of pride in saying that we've actually paved the way. For someone to start digital lending today, they literally just take replication. And just to give you an example, right, we actually had to go and fight it out with RBI saying that we don't want a process where so one of the older laws required that when you collect fees from the customer, you have to give them a physical red stamp that you have to sign across. We actually lobbied with a lot of governmental agencies to get that changed. Until then, you couldn't do digital lending. Nash became digitized now, but we've actually paved the way, took out all the roadblocks to do digital lending. But my belief with product innovation is not limited to the actual lending journey itself. Lending has now become commoditized. For me to assess a customer, to give him a line where he can take a loan at whatever point of time he wants, has become very, very simple. The magic of product innovation lies in the other aspects. What we did with Ring is not very different from what we are doing with Kissht. What we did innovation is on the customer acquisition side. We went and changed the model on how we can acquire a customer for 80, 90 rupees versus say spending 400 rupees on a customer. The other part of the innovation we are doing is getting the customer to be a lot more engaged. The biggest challenge we saw with Kissht is a customer will take a loan and completely go dormant for 6 months. 6 months later, when you wake him up and ask him what Kissht is, he'll say, I don't know, I don't remember. Because he's taken a loan, doesn't have a recall of the product. 6 months later, when he wants to take another loan, his expectations of everything are reset. He'll again go and scan the market for different players. We could not build a brand loyalty for lending as well. So what we did with Ring is we brought in this element of transactional credit where we're giving them a limit to use for all of their purchases. He can go to any Ring merchant. We have about 3 lakh merchants on our platform and they're in clusters. So if you live in a locality, most of the merchants around you are already on the Ring platform. And you can make your daily purchases for your milk and your groceries on the Ring transaction credit. We set it off or we entice them by giving them cashbacks and rewards and loyalty, the things that everyone is doing. But now you're doing it for a product that is a credit product, which is very different from what has been done traditionally so far. Product innovation also comes in a lot of different areas for us. The core fundamental piece or the USP of our company is the credit and fraud engines. There's a very large analytics team. There's a dedicated engineering team that keep focusing on looking at fraud elements day in and day out. Different data points. Literally every year, there are new data points that you can assess. Last year, for example, we got a bunch of additional data points from a bunch of fraud detection companies that took our fraud efficacy up by some 8.5-9%. So you keep innovating on those aspects. Of course, your customer experience is always paramount. But on customer experience, it's possible that you can get to a stage where you're happy, you're content. But the real innovation happens under the cover. For a stellar customer journey, it's very easy to build a fantastic customer journey. It's all the hard work that goes on in the background to power that seamlessness, to do it with the right risk mitigants in place, and to end up at the end up with an NPA number that will allow your company to sustain is where most of the product innovation for us lies now.
One of the mistakes which fintech startups we've seen make, especially in the lending space, is focusing on AUM, right? It's not about how much you disburse or what are your assets at any point in time. It's the collections that matter the most, right? And that's our learning over time, and that's what we've learned, right? Especially in a lending business. And I think that's one area that I think Kissht has been able to create a tech stack and a model that works. It's proven. So I think it's important for everyone to understand that, and if you can throw some light on that.
No, absolutely. One of the biggest cliches you'll hear from everyone in the lending industry is it's very, very, very easy to give out 1 rupee in loan. It's equally hard to collect that 1 rupee back. And as cliche as it is, if you don't have it in the back of your mind when you're starting a lending startup, I will guarantee you will crash and burn before you can imagine. When I talk about the cohort of all the companies that started in 2015, since 2015 to now, every month I'll hear of a new lending startup come up. And the lending startup ecosystem is filled with graves of companies who did incredible product innovation, created killer products for the customer, came up with a very, very different insight on how to acquire customers. But they all crashed and burned very, very quickly for a very simple reason, is because while you focus on the customer aspect of innovation, you have to be equally cognizant of the collections aspect. Just one anecdote I'll share is we partnered with Flipkart. We were their partners for their entire cardless credit and BNPL journey for a good 2 years. And there always used to be these tussles where the product managers of Flipkart will say, "Oh, I want to make the journey more simple for the customer." We'd say, "We'll happily do it for you, but then there will be a risk attributed to it. Whatever that comes up, you should bear the cost for it." They very quickly used to backtrack. "Yes, I can make a fantastic product experience, but if it comes at the cost of risk, we can't do it." For being able to collect well, the journey always starts with the right credit decisioning. That is where we've invested a lot. The other aspect where we invested a lot is on the collections tech stack. The ugly side of lending is always that you have to do recovery. You will have to go to a customer who unfortunately is probably having a hard time as it is, but still asking for money. One of the challenges we face is we want to create a fantastic brand reputation, but it always gets sullied, of course, by customers who are irate because we are calling them for recovery at a time where they're actually facing hardships. But the reality is, if you want to build a lending company, you will have to face that ugly side of the business as well. Of course, we try to do it in the most moral way possible in compliance with all RBI guidelines. But there is no taking it from the fact that it is an unseeming part of the business. At Kissht, one of the benefits and one of the things that I think really made a difference in our survival story is two of my co-founders come from a pure risk background. They were McKinsey consultants working with the largest banks in India and Southeast Asia, only on the risk side. So before they learned lending, they actually learned risk. So, on day one, we have invested as much of engineering, money, resources, and mindshare at a founder level on collections as we've done on the user app. One of the testaments, and I love to usually demo this whenever you're doing demos to investors, I show them the collections app that we built. It is actually as polished as our user app. The UI UX has been thought out with as much care and detail as we've thought out our user app itself. Because we believe, and we've invested on it from day one. When we started the customer side of the journey, we had a collections app as well. Very, very few companies do that. The largest banks outsource their physical collections to other companies. We decided to do it in-house. Even our call centers, the collection calling centers, are literally run like a very, very tightly controlled shop. We control the auto dialer, we control the CRM that the collections caller uses. Other than probably the collections team member themselves, which are usually on contract, everything is tightly managed by us. That focus on collections from the very, very beginning and till date, I think founders spend, between the 4 founders, we spend cumulative at least 30 to 40% of our mindshare on the collection side of things, as much as we do on the user-facing side of things, because we quite literally know that a couple of bad cycles will probably mean that we are teetering on the verge of, shutting shop. And that's the mindset you have to run with. It's difficult for me to emphasize how many promising lending startups I would have wished they would have succeeded. And they couldn't because they just didn't pay attention to the collection side of things. And it's a tricky business. You have to be, in line with RBI regulations on how to do collections. You have to be empathetic enough. You do see real cases of people who had a loss of job, have had had an accident. How do you create SOPs that allows the collections team to take those decisions? to be empathetic at the right places, not to have the escalations. We have created a lot of innovative products on the collection side as well. Moratorium is something now we've all become familiar with. We've created what we call an EMI holiday at no cost to the customer. He can choose any 1 month in his entire cycle to push it off. We do restructuring and settlement very, very conveniently within our app itself. And all of those are also product thoughts that we've done, which larger banks like HDFC and Bank of Baroda are still struggling to even bring in. One of the running jokes in the company is that if you were to take out our collection stack and create a separate SaaS company, probably that'll be valued more than the company itself. And lots of temptations over the years to do it. And at some point of time, we might just do it, but that's the level of attention we've paid to the collections tech stack.
Let's move to the next interesting topic, regulations. Right? How has that been panning out for you? Any ask from the regulator?
No, many asks. So first of all, let me start by saying that RBI as a regulator, NPCI as a supporting body for almost everything in payments and settlement have been incredibly forward-looking. They, of course, do come across as a strict mom, keeping all their children in line, doing exactly the job that they're supposed to be doing. And of course, a child will also get angry at their mom or not be unhappy with their mom at certain points of time, but it's that kind of a relationship. You cannot emphasize enough that NPCI and RBI together have kind of paved the way for a lot of innovation on the digital side, right? Not just lending, insurance, wealth tech, of course, payments. UPI has been a game changer for more reasons than one can enumerate. And they've thankfully also taken the right, proactive measures on curbing some of the practices that should be curbed. RBI stance on collections heavy-handedness has had a fantastic effect for the consumer. RBI's focus on customers' data privacy, information security, as well as data localization are things that we are big proponents of ourselves. And in India, for a country of India's size, without strong regulation in place, you will all of a sudden start seeing loan sharking behavior. Pretty much every corners will become a social problem, quite frankly. And that's why I think RBI has played a fantastic role there. Having said that, yes, from time to time we have many asks from RBI. The good part of RBI is they are also very open to free dialogue. We have an incredible rapport with RBI. We talk to them, we give them our feedback, they give us their feedback, they give us their thinking. They tell us where they would want the space to go, and RBI is incredibly supportive of the fintech industry in general, especially the lending tech industry. The asks that we have had largely from RBI is we need a lot more, a digital first thought process going into RBI. RBI has set up a fintech division. We are expecting and they are moving at a good enough pace, but the fintech space is moving at breakneck speed. One of the very cool things that has happened is when we started, less than 180 million customers at CIBIL Records. In a span of 4 years, that has gone to 400 million customers. So all of a sudden, India is becoming very credit savvy, tech savvy, financial payment savvy, and that's to a large part being aided by private fintech players. We need a lot more room for innovation. The RBI's plan with the sandbox approach, a lot of leverage on being able to innovate on the digital lending side has reaped rewards, but I think it can be done at a much faster pace as well. Some of the rules. In India, credit card issuance being limited to banks is, I think, something that we could introspect on why that needs to be the case. Credit should be credit. Why not let the newer age NBFCs to start issuing credit cards? It could have a different effect on financial inclusion. Credit cards are a form factor that are easy to understand. With UPI linked to credit cards, we can see another big boom in UPI as well. But credit cards are currently limited to the purview of banks, and banks still operate with the risk models that they've been operating with, which does not allow them to serve a good 90 to 95% of India's population. This is the place where fintechs will shine. Fintechs can take a easy to sell credit product is something that fintechs will probably go and make large part of India have access to very easily. And this is where we have, of course, in many discussions with the RBI to allow us to use some of the credit products that are limited to banks right now. Something as simple as an OD account is something we are not allowed to offer. It's a product that customers will understand. A limit-based product is what a customer with a with a plethora of BNPL apps that pervaded, we realized the customers understand a limit-based product a lot better than a loan-based product. But an OD kind of a product is not, in the purview of NBFCs right now, limited to certain NBFCs and banks. This can be very, very easily democratized with the right, safeguards in place to prevent misuse for the customers.
So I think UPI linked to credit cards, credit accounts is a trend to watch out for sure, right? Like
yes, so it's one of the things that is something I'm very, very, very bullish about. I think UPI on credit, in any developed country, credit cards are close to 50-60% market share. And cards only because there the form factor is only cards. In India, of course, the prevalent form factor is UPI. So the moment you have a good UPI on credit product available, you can just very simply take a simple assumption that the usage of UPI will double overnight.
Correct.
UPI is already literally crushing records month on month.
Yeah.
And you have this potential for it to literally double overnight.
And I think
one
of the things we've also realized is credit is most effective when it's at a point of sale, right?
Absolutely.
And so that's just going to take it to the next level completely.
Correct. That's exactly by the way the thesis for Ring. When we tie with merchants, the reason for CAC being much lower is when you kind of try to do advertisements for customers, loan is available, come to Kissht and take a loan, customer will register it, forget it 10 seconds later. When he's at the merchant shop and the merchant offers him credit for the first time, usually doesn't take it because he has money in his wallet because he's come for the purchase.
Yeah.
But the customer already registered that अच्छा वो merchant के पास जाऊंगा तो मुझे credit मिल जाएगा. Usually what we've seen from a behavioral perspective, the customer goes second time, he actually goes to the shop without money in his wallet because he's confident that he's going to get a credit. And that's where the model of Ring of acquiring customers at the merchant shop has worked wonders for us from a CAC perspective. The same thinking, of course, applies to BNPL. Having, lazy pay button at the checkout of Swiggy makes you very, very, the seamlessness, of course, but the access to credit probably will make you add one more item to your cart before shopping. And that works. It works from a psychological perspective. It works, just from an acquisition perspective. And that's where we believe UPI credit is one of the trends to watch out
Absolutely. for. I think coming to the next interesting topic around, have we hit a funding winter? Are we there yet? Or is it past? Actually.
So depending on whoever you speak to, right? It's like I don't know if you guys have seen Groundhog Day, but there's I forget the name of the animal, but there's a animal that pops up and says that whether the winter is going to last another couple of weeks or not. Depending on who you speak to in the industry, I think you get very, very varied answers. Without a doubt, the case whether or not there was a funding winter was very evident. I think there was a massive chill. If you ask me very personally, it was a very, very natural chill given the heat wave we saw in 2021 and a natural follow-up incident to what happened in 2021. Lots of bad bets being made, lots of realizations having creeped in. We've been speaking to a lot of investors, of course, our existing investors who are looking at other opportunities. And when we talk to a lot of the investors in the market, we realize that it's not that there is a funding winter of saying that we don't want to invest money. A lot of them, there's this term that is being used massively here. It's called dry powder. If you talk to anyone, everyone says, oh, we have a lot of dry powder. They have a lot of capital to deploy and they have a lot of pressure to deploy that capital. The only thing that has changed is, their outlooks on how to do valuations, how to evaluate companies, how much of a risk they're willing to take has massively changed, and it's changed for the better, in my opinion. They're actually very actively asking business models, revenue, profitability outlook, the absolute right question that they should have been asking back in 2021 itself. But no, the interest is there. If you have a fundamentally strong proposition, there is enough and more investing opportunities. If you don't have a strong proposition, yes, you are going to see it as a funding winter. One of the best parts of this funding winter has been, I think, seed and early stage companies have had a fantastic run, which I love. And the more seeds and the more Series A happening right now means a more dynamic landscape 4 or 5 years down the line. While there was a massive chill on the Series B, C growth stage funds, the seed and the Series A, funds were having a party because all of a sudden they could get slightly lower valuations because of the overall depression in the market. That's been very, very good. Now, when we are even talking to growth stage companies and even PEs, they are in the mood to deploy their capital. They are talking to us very actively. They're talking to a lot of people in the industry very, very actively. Valuations are subdued compared to what they were in 2021, but one could always argue that the 2021 valuations were not realistic to begin with. So at least the bottom line is, with a fundamentally strong proposition, a good team in place, a good execution strategy in place, it's not going to impact you. And across the globe, I think India is overall in a much better situation than some of the other economies are. So to be in the right space in India, it's not a bad time at all.
It's a crowded space, right? We spoke about that. I
Yes.
mean, everyone's doing everything. There are banks, there are NBFCs, there are lending startups, there are card lending, there is BNPL, right? There are merchant acquirers who are now doing embedded finance.
Yes.
So is it really like too crowded a market, and how do you see the survival of the fittest in this?
No, so when you the way you described it is, yes, it's exactly like that crowded. When we look at our competition, we are competing with companies of all sizes and all scales. You have nimble companies who have come up literally 2 years ago, and they're fighting for some market share. You have banks who've learned how to be truly digital, and I'll give a lot of credit to the Indian banking ecosystem. As much as we had bet that they'll be slow movers to adopt digital, some of them have really paved the way, and it makes me happy. It makes me happy because it's ultimately going to result in a better customer experience. When you talk to the IDFC First banks or even HDFC banks, right, they're moving at a pace that will put a lot of startups to shame. So yes, we are seeing competition from all sides. The good part about lending in India is such a big pie that if everyone takes a big bite out of that pie, there's still going to be a lot left over for for everyone to be saturated. The other good thing about the industry has been that there's actually a lot of collaboration. All of us lending fintechs are actually collaborative. We have a very, very open line of communication with each other. We help each other out in every way. The credit bees and the early salaries, the CEOs are friends, the CTOs are friends, the risk people are friends. We are sharing tips, tricks, advice, everything that needs to be shared in a very healthy way. Banks are incredible partners for us. Banks and the larger NBFCs are the ones who are betting on us. They're saying that you guys are good at acquiring, we guys are good at managing capital. Let's get together and create a fantastic ecosystem for the customer. In general, in India, lending is still a very, very big untapped opportunity. While we are all trying to go wide in India, we are all still scratching the surface. I truly believe that with the right innovation that we've not seen yet, it's yet to come. There will be acquisition models that allow you to go to the people in the furthest villages, being able to lend to them, being able to recover from them, to be able to do all of this in an LTV positive manner, which I believe is at least a 10-year story from now. So there's enough and more population that needs access to credit. And this is, by the way, the same population that truly needs access to credit, because credit always acts as an accelerant. It acts as a catalyst for their economic growth. And those are also the people where credit is currently not accessible. I believe that, when the first wave of lending fintechs truly accomplish what they're trying to do, they will want to expand their horizons. They'll go deeper into geographies. They'll go deeper into segments. And a lot of potential is yet to be unlocked. And I don't think it's competitive in the sense that there is this one customer that 5 of us are competing for. We are all competing for 5 customers, and there are 25 to be had. It's about getting the eyeballs of those 25 to us. So it's more of a marketing brand recognition game right now. But there is no dearth of credit requirement in India. It's not going to be there for a very, very long time.
Closing remarks on predictions, Karan. How do you see this industry panning out?
Right.
I think the way we've seen the latest trend, which I think is picking up now, is this whole concept of ecosystem banking, embedded finance linked with that. I'm quite intrigued to, at least understand how that pans out.
Right.
Any thoughts, anything?
No,
on the
I
ground
think
that
what
you're
you're
seeing?
suggesting is where it is very quickly going to evolve to. So, if I had to predict on the fintech industry in general, I think there are 2 large themes. One that I'm personally a very very bullish on is credit on UPI is going to unlock incredible opportunities for everyone in the ecosystem. Of course, for all of the sellers, the e-commerce companies, and the D2C brands, they're gonna benefit a lot from UPI credit opening up. It's gonna bring a bigger base of customers. Customers are gonna become financially more independent to make those choices. The second thing, along the lines of what you're saying, embedded finance, what we've seen so far for the last 8, 10, 12 years in India has been digitization of existing products. We all of a sudden have seen insurance become digital. You've seen lending become insurance digital. You've seen wealth tech becoming digital, where everything can be done on an app. But if you take a step back, you'll realize, okay, no innovative products have been created yet. That's basically products that we were familiar with, have been brought to a mobile phone, are being able to do without a human interaction required. Where I believe the true innovation will come is now the second layer of innovation, which will be a weaving of all of these products together. You will see innovative products that combine insurance and lending, insurance and wealth tech, or literally something that comes out of the left field. One of the predictions I have is these products, when we take a look at them, we'll say that, oh, this was very obvious. We don't know why it wasn't there, but it's going to be an innovative product. I mean, not the best example, but Zomato giving you an RBL card, which has points specifically for Zomato within the app itself, is one layer of, or the first, inkling of what that is going to be like. Financial fintech will probably become transparent. You will do what you're trying to do. You're trying to buy an item. You're trying to buy a service. You're trying to take a holiday. The fintech part of it, the insurance required for your trip, the credit that you require to actually afford that trip, the investments to allow you to take a trip 5 years from now, all of that might become just completely transparent. Lots of innovation from the government side, open APIs for banking, the accounts aggregating ecosystem, all of that is going to make a big dent in the ecosystem. One of the other predictions I make is whether you're insurtech, lending tech, whatever kind of tech, everyone's going to converge into a neobank in some shape and form. But that's, I think, what the consumer will demand. They will not want to deal with fintech. They will want to deal with Amazon and Swiggy and Ola and Uber. Everything else becomes transparent.
Okay. Thanks, everyone.
Thank you so much, Geetika. Thanks, everyone.